In your view, are there any difference that we can expect in terms of the recovery if we compare the post-2000 bust of the dot-com to what we can expect moving forward at this particular time, given changes in the marketplace, regulatory changes, and perhaps changes in investor psychology as well?
Happy to answer that. Just a little bit of historical perspective in the technology IPO market, which has been my privilege to participate in since the early 1980s. It's been a market that was, in the 70s, kind of a backwater. It was kind of a by-exception market. That was the time when great companies like Intel and Rome and Tandem went public. But back then, there was only maybe 5 companies a year that came public. The average deal size was maybe 10 million. It was really Apple's IPO and Genentech's IPO in 1980 that started to institutionalize the market. And so in the 80s, that decade that was personified by Apple, there were 32 IPOs a year in technology. If you look at the time frame where Cisco and Netscape and the internet started to be formed, the first half of the 90s, there were over 100 IPOs per year in the technology sector. The first wave of the internet, which captured Amazon's IPO, which I had the privilege of leading, there were 240 deals a year. And in the crazy years of 1990 and 2000, there were almost 400 deals per year. Now, after that bubble burst, there were a couple of years where it was really lean, but for 2001 through 2007, there were 62 deals per year, and $80 billion of proceeds were raised, about $11 billion a year. In the last 2 years, just to put that in perspective, my numbers are different because I'm dealing with global tech IPOs and not just venture-backed, but there are only 18 a year. And the market was about $3.5 billion per year. Those statistics are lower than the 1980s, sort of puts you between the 70s and 80s. And so it's really very, very dramatically different. And will it recover to the same extent? I'd say no. And I think some of the key differences this time are the fact that in the 99-2000 bubble, it was really focused on internet and telecom. And it was mostly a US kind of phenomenon. And the broader S&P, the broader industries, they didn't go down nearly as much. NASDAQ down over the 2000 to 2003 timeframe was down 80%. I don't think the S&P got down more than 30% during that period of time. This time, it's been much more deep, much more broad, much more global. The bust this time, took 17 months to reach down 50%. And it was down 50% not just in NASDAQ, but in S&P, in the Dow, and the financial services industry, which is the real big change this time, was down 83% during that period of time from October 2007 to March of 2009 when things bottomed out. The thing that brought the market back last time were big IPOs for Google and VMware, but also the fact that there was a lot of credit flowing through the markets. The LBO firms started to become a big part of both the M&A market as well as the IPO market. In technology, that was unheard of. About 25% of the market during that mid-2000s time frame, both the M&A market and the IPO market came from LBO firms buying big technology companies and taking them private and then taking them back public again. This time, there's really no credit. It's really a have and have not market. The top dozen tech companies that have 5 to 30 billion of cash have a big advantage over the others, but credit is largely unavailable to the mid-sized companies. And so that's one of the main changes. Also, the number of suppliers of the service underwriting, taking companies public, has shrunk dramatically due to companies going out of business, companies merging, and such. And the big companies now sort of have a chokehold on the distribution, and they're not letting companies come public unless they have very, very large revenues and prospects for big market caps. So I think it's different. I think it's going to take a longer time to come back. I think we're going to need to get the credit flowing in the economy again before things really open up again.
Meanwhile, we live in a world where M&A transactions are the dominant form of exit. If I look back to 2009, in Q3 of 2009, 11 out of the 22 disclosed deals were transactions that were valued at less than investment. Only 2 of the 22 disclosed deals had a 10x or higher return. So, Frank, you're an investment banker, a prominent investment banker. Would you offer any thoughts on your views on whether the M&A market in 2010 is likely to recover? We have had a slow January. Most of the indices are down. What's your view?
So I want to emphasize and agree with what Ted said. It's a fallacy that when stock prices go down, M&A activity goes up, because when stock prices go down, the buyers have lost confidence. And you need the CEOs of the big companies to have confidence, predictability, visibility into their own businesses before they're willing to pay imaginative prices. So if you're in the middle of a credit crisis, when there's maybe only 10 technology companies that could buy properties for cash, but they're worried, are they going to have earnings in the next quarter, and are they going to have customers because all their customers can't afford to buy the products anymore, they're not going to be thinking too much about M&A. So my statistics showed that in the fourth quarter of last year, of 08, in the fourth quarter of 08, the annualized M&A volume in tech was only $13 billion, and that was our Brocade Foundry deal times 4. And there wasn't a whole lot of deals happening. In 08 as a whole, it was $77 billion, and last year we track it at $90 billion. So there was a slight increase year to year, but most of that activity took place in the second half of the year. So we think that activity is in fact accelerating, and there's a variety of reasons. One is interest rates remain low, so the opportunity cost of taking cash off your balance sheet and buying earnings it's a good deal. Secondly, confidence is returning. We think that we've bottomed. March of 09 is generally what people think was the bottom of the stock market and the economic problem. Now, we're not recovering as fast as people would hope, but I think people are now saying, okay, the worst is over. Now I need to go take a look at what's happening. The third
You
thing,
believe in that?
Yes, well, I do. I also think, however, that stocks are way ahead of where the actual economic recovery pace is going to be. So I think that if things don't really start growing, there's risk in PE levels right now in the marketplace. But getting back to why M&A is going to improve, there are some structural things going on in technology, some industry trends that are really, really much more powerful than stock market fluctuations that are driving it. We're going from a world where there were horizontal specialists, Oracle and database, Intel and chips, HP and servers, Cisco and networking, EMC and storage, to one where now a few very large companies want to control it all, back to the mini computer and mainframe days. So Cisco is in the computer business, slapping HP and IBM and Dell in the face. HP's bought 3Com, redoubling their efforts in networking to compete against Cisco. Dell bought Perot Systems to be in the system integration business when all they've got to sell is servers, but they're going to probably want to flesh out their technology stack. Oracle bought Sun. They're in the hardware business now. They can control everything from
Competing
servers through applications. And Oracle's now controlling the agenda in the industry. And so before, when you were a networking startup, the only company really that could pay a big price for you was Cisco. Now you've got 6 companies, all of whom came from it from a different perspective, hardware, software, internet, whatever, and they all want to buy a networking company. So we think that the buyers for individual technology components are broadening, and so that's creating competition. And you're seeing even some public bidding wars, like our data domain deal with EMC and NetApp. You're also seeing some trends in mobility, such as Apple getting into the cell phone business. Apple and Google's in the cell phone business. Apple and Google used to have common board members. And so now these two are competing for mobile advertising properties. Apple hasn't bought anything historically. They've got $40 billion of cash on their balance sheet. Apple getting into the acquisition business is the best thing I've seen happen in a long time. And then you see this new world called software as a service in the cloud, and that's a new area where there's no ground rules and where these former partnerships that governed, this Cold War, it's like the wild, wild west again. So we think there's a lot of structural change going on in the technology industry across all of the sectors, and that 5 years from now you won't be able to tell a storage company from a networking company, from a software company, from an internet company. Everybody's going to try to do everything and grab that land again. So I think it bodes well for strong M&A activity going forward.